We're checking a lot of boxes for things we like to see develop at or near tactical lows. Like, let's remember, NASDAQ down 18, high to low, S&P down 12, high to low. We look for two things really to develop at tactical or tradable bottoms. Number one, we look for stress in sentiment. We see it with put calls. Put calls up in the 95th percentile 3 days of the last 5. So you're seeing stress in the options market. Secondly, we look for stress in price, right? We've seen 1 month lows surge on the S&P. We've seen 3 month lows surge on the Russell 2000. Those are conditions you tend to get at or near tradable lows. I don't know if it's today or next week, but I think we're in the ballpark here of where we can get a pretty good rally into the spring. It's consistent with the midterm election seasonal as well. We tend to see weakness in January, February, rally into the spring. I would also just note, Andrew, what's been so important to us is how the character of this correction has looked different than anything we've seen in 13 years of the QE regime. This is a market that's down with bond yields up. We haven't seen that in 13 years. This is a market down with energy stocks up. We haven't seen that in 13 years. Something is changing. The regime is changing. Value versus growth just had its best 2 months in about 15, 16 years. So we're seeing the character of this decline very different than what we've seen in the past.
What do you do about financials then in a market like that, given what you just said?
I think what's been unique, and this is not just distinct to financials, this is distinct to every sector. Every sector has its FANG-like stocks, and every sector has its value-oriented names. When you look in financials, look at what's working. Community banks, regional banks. Look at what's not working. Publicly traded private equity, exchanges. Look what's working globally. First time in 16, 17 years where you have European banks breaking out, you have Japanese banks breaking out. So, this value versus growth shift that I think we're all observing is not just about owning energy and selling tech. It's in every single sector. You see the value-oriented names exhibiting leadership. Community banks, regional banks, European banks. I think that reflects the rate environment. And we have German 10-year yields about to go zero for the first time in 3 years. We have Swiss yields above zero for the first time in 3 years. There is a regime shift that's under our feet right now, and I think we ought to pay attention.
Gabrielle, you agree with that? And I mean, you work at a big bank, so maybe you have a different view.
No, absolutely agree in the sense that this is a regime change. The last 13 years is not the blueprint we should be looking at. We actually should be looking at the previous decade before that, when we had a cycle of stronger growth, slightly higher inflation, and higher rates. And that's an environment where not just growth can do well, but also value, where not only the U.S. can do well, but other cyclical regions as well, and where it's really important then to take profit in those areas that worked over the last 13 years and rebalance into the areas that haven't worked, but are likely to participate in a rally going forward. And one of the things we've been really stressing to clients is that this is the very different beginning of a cycle than it was in 2008. Valuations are already extremely high at the index level. That suggests very muted returns going forward. From beta, we project only 4.3% in a 60-40 portfolio. So it's really the dawn of alpha, and that requires action, rebalancing, looking at new asset classes, new regions.
Shepard Smith here. Thanks for watching CNBC on YouTube.